ICT concepts are impactful, but let's be real, many traders find them hard to grasp. Liquidity, fair value gaps, order blocks, they're usually broken down in a way that seems confusing, even intimidating. In this video, you'll finally get a clear view of smart money trading, simplified. You'll discover what liquidity truly means and how big players exploit it against retail traders. The hidden logic of fair value gaps and how to confidently trade them. The power of three and how smart money lays traps ahead of major moves. How to identify and execute valid order blocks like a seasoned trader. And most importantly, how to use these methods on real charts, step by step. By the time you finish this video, you'll know how to identify liquidity traps and avoid getting taken out. Trade fair value gaps and order blocks with clarity and precision. Spot smart money setups like the power of three. Build trade entries based on actual institutional behavior, not assumptions. If you're ready to stop trading like the masses and start thinking like smart money, don't forget to like this video, subscribe, and turn on notifications so you never miss a strategy breakdown. Seasoned trader. And most importantly, how to use these methods on real charts, step by step. Let's dive in. We'll begin with the core of all smart money concepts, liquidity. Liquidity points are areas on the chart filled with pending orders, mostly stop losses. These regions act like magnets for smart money. They're fully aware of where the majority of retail traders place their stops, and their goal is to target and trigger them. Here's how it works. You buy at support, right? Your stop loss goes just underneath. The market dips, takes you out, then shoots upward. Sound familiar? That's no accident, it's a liquidity grab. Price isn't moving randomly, it's deliberately engineered. To trade like smart money, you've got to spot where liquidity is sitting. ICT explains it in two types. The first is buy-side liquidity. Buy-side liquidity means buy stop orders, usually set above price, above old highs, weekly or daily highs, or equal highs. Why are they placed there? Because traders holding short positions want protection, so they put stops above swing highs. Breakout traders also use buy stops to catch upward moves. Smart money knows this, so they drive price just above those highs, trigger the stops, use the demand spike to fill sell positions, and then flip the market. That's what's known as a buy-side liquidity grab. Now let's switch it up. Sell-side liquidity comes from sell stop orders, which sit below price, beneath prior lows, weekly or daily lows, or under equal lows. Traders in long positions set stop losses below major support. Breakout traders place sell stops to catch a breakdown. Smart money sees this setup too. So what do? They drive price below support, trigger those stops, use the wave of sell orders to fill their buy positions, and then reverse the market upward. This is the core idea behind a sell-side liquidity grab. Now that you've got a handle on how liquidity works, let's break down two common liquidity traps you've likely seen before. We'll start with a buy-side liquidity trap. Check out this chart example. The market's moving sideways. You spot a clear resistance zone, looks like an ideal place to go short. So you take a sell position, placing your stop just above resistance. At the same time, breakout traders are stacking buy stops above that level, expecting a bullish move. But here's what goes down: price suddenly pops above resistance, wipes out the sellers, triggers the breakout buys, then quickly drops back into the range. Both sides get taken out. That whole move, just a liquidity sweep, a textbook buy-side stop hunt in a ranging market. Alright, now let's walk through a sell-side liquidity trap. Here's how it plays out. The market's in a downtrend. You notice a strong support zone and enter a long trade, expecting a bounce, with stop losses placed below support. Meanwhile, breakout traders are lining up sell stops below that same level, anticipating a breakdown. Price breaks lower, triggers both sets of orders, then quickly snaps back up. Both sides get caught. The actual move only begins after all that liquidity has been cleared out. Now let's get into a crucial concept smart money traders rely on for sharp entries and exits, the fair value gap. So, what is a fair value gap exactly? It's a price imbalance that forms when the market moves aggressively in one direction, so fast that it leaves an unfilled space between candles. This gap marks a zone where price didn't spend enough time, and because of that, it often acts like a magnet, drawing price back in for a retest. Traders use these gaps to spot high-probability entry points, and when applied properly, they offer pinpoint accuracy. To identify a fair value gap, begin by spotting a sequence of 3 back-to-back candles. You're looking for a strong candle in the middle, one that moves decisively in a single direction, flanked by 2 smaller candles. Here's the key. If the high of the first candle and the low of the third candle don't overlap with the middle one, then a gap is present. That space between the first candle's high and the third candle's low is what we refer to as the fair value gap. Once spotted, mark that zone with a rectangle on your chart. That's your point of interest. This applies both ways. In bullish scenarios, the gap forms during a sharp move upward. In bearish setups, it appears as price drops swiftly. Just remember, if the first and third candles overlap the middle, there's no valid fair value gap, no matter how large the middle candle is. Let me give you 4 actionable tips I follow to cut through the noise and zero in on high-quality setups. Tip number 1. Stick to unmitigated gaps. The most reliable fair value gaps are untouched, meaning price hasn't come back to retest them yet. Once price revisits and taps that gap, the area is considered mitigated and loses its strength. So if you find a fair value gap that's already been tested, it's best to pass on it. Also, avoid setups where price retraces too far. If it closes inside or below the gap, it's no longer valid. Ideally, price should tap the zone, respect it, and bounce cleanly. Tip number 2. Size does matter. Bigger fair value gaps typically present more reliable setups. Why? Because a wider gap signals a stronger imbalance between buyers and sellers, increasing the chances that price will return and respond to that area. When you're looking at several fair value gaps on the same chart, give priority to the larger ones. They usually carry more weight. Tip number 3. Be cautious with fair value gaps that form near key levels. Here's a typical trap. You find a clean-looking fair value gap, but it's sitting just below a major resistance zone. That's a warning sign. Why? Because price might hit that resistance, reject sharply, and cancel out your fair value gap setup. Always scan the bigger picture. Stay away from gaps that are too close to clear obstacles like support or resistance. They can easily disrupt your trade. Tip number 4. Prioritize fair value gaps that appear right after a break of structure. Some of the most dependable setups form when price breaks a significant level and instantly leaves behind a fair value gap. That area often becomes a prime spot for smart money to step back in. The first retest of this kind of fair value gap usually sparks a strong reaction, making it a high probability zone for entries. Now let's shift to another impactful ICT concept, the power of 3. This smart money trading pattern breaks down price movement into 3 distinct phases: consolidation, manipulation, and acceleration. Let's begin with phase 1, consolidation. In this stage, smart money starts accumulating positions subtly while price drifts sideways in a narrow range. To most retail traders, the market seems flat or indecisive, but this phase is key. It sets the groundwork for the upcoming big move and marks the initial stage of what's known as the power of 3. Next is the manipulation phase, where price fakes a breakout either above or below the range. This move is meant to deceive retail traders by triggering stop losses and pulling in breakout entries. It's a textbook liquidity sweep, engineered to activate orders from unaware participants. A sweep often happens when price breaks beneath a clear support and quickly snaps back into the range. This false breakout isn't a genuine trend reversal, it's a smart money tactic to grab liquidity before the actual move. Once enough orders are collected, smart money launches price forcefully in the opposite direction. That swift push is known as the acceleration phase. This is where momentum kicks in, and it's your chance to catch the move right after the trap, in sync with the institutions. Ride the acceleration, don't chase it. That example illustrates the bullish version of the power of 3. Now let's look at the bearish version. This pattern usually shows up at the top of an uptrend, signaling a shift toward downward momentum. It kicks off with the first phase, distribution. During this stage, price moves sideways in a narrow range, but behind the scenes, smart money is unloading their long positions, selling into strength, while retail traders continue to buy. Then we shift into the manipulation phase. Price breaks out above the range, triggering stop losses from short positions and attracting breakout buyers. Retail believes it's a bullish continuation, but it's actually a setup. price swiftly falls back into the range, exposing the move as a liquidity sweep. Lastly, we enter the markdown phase. Smart money is out, the liquidity has been collected, and price has clear downside room. This is your window to enter right as the trend reverses, catching the momentum shift created by institutional players. Now let's talk about how to actually trade the power of three, both bullish and bearish setups. Once you can recognize the pattern, the next step is executing with precision, entering at the right time, managing your risk, and setting targets like a pro. In an uptrend, smart money will eventually begin to take profits. Here's what you need to watch for. First, look for the distribution phase. Price begins to range after a strong move upward. This is where institutional players start offloading their positions. Then comes the manipulation phase. Price breaks above resistance, triggering buy stops and stop losses from short sellers. Here's the key. If price closes back inside the range after that breakout, that's your confirmation. It's not a real breakout, it's a liquidity sweep. Your entry comes on the candle that closes back inside the range. Set your stop loss just above the high of the breakout candle. Your take profit target, the next major support level. This approach lets you capitalize on the markdown, the acceleration phase, catching the move right after smart money traps retail traders. When the market is trending downward, smart money eventually starts hunting for long positions. Here's how you spot the reversal. First, identify the accumulation phase. After a strong downtrend, price begins to consolidate and move sideways. To most traders, it looks like indecision. But to smart money, it's a setup. Next comes the liquidity grab. Price breaks below support, triggering sell stops and attracting breakout sellers. But here's the twist. If the next candle closes back inside the range, that's your signal. The trap has been set. Smart money is stepping in and accumulating. Your entry is on the close of that candle that reclaims the range. Set your stop loss just below the recent swing low. Your target, the next significant resistance level. This is your opportunity to catch the markup phase, the explosive move upward, fueled by institutional momentum. Let's move on to another key smart money concept, order blocks. Here's the breakdown, no fluff. An order block is a specific zone on the price chart where big players, think banks, hedge funds, and institutions, have placed massive buy or sell orders. We're not talking about retail-level trades. These are multi-million, even billion-dollar moves. And when that kind of money enters the market, you can see the footprint. Order blocks reveal the last area where smart money made a decisive move. When price returns to that zone, it's often to rebalance, re-enter, or trap retail traders. That's why these areas become high-probability zones for reversals or strong continuations. In simple terms, order blocks equals smart money footprints. Follow them, and you're no longer guessing, you're aligning with institutional flow. Ever seen price shoot up or drop hard from a specific level, almost out of nowhere? That kind of move is rarely random. It's usually the footprint of smart money. The exact zone where that explosive move started. That's called an order block. There are two types. Small diamond bullish order block, formed when institutions drop massive buy orders, launching price upward. Down triangle bearish order block, triggered when they dump large sell positions, driving price sharply lower. Once these zones form, they're not just forgotten. Price often returns to test them. Why? Because the market wants to see, are the big players still defending this level? And that retest, that's where you come in. It's your high probability entry point, if you're aligned with the smart money flow. For instance, let's say price returns to a bullish order block, but this time, it starts showing signs of strength. You see rejection wicks, bullish engulfing candles, momentum building. That's your cue. Why? Because you're not just trading any level, you're entering at the same price point where smart money previously stepped in. And when you align your trade with institutional intent, you're not guessing, you're following the money. This is how high probability setups are built. Enter with precision, manage risk smartly, and let the market do the heavy lifting. Order blocks might look like support and resistance at first, but the difference is huge. Let's break it down. At first glance, yeah, they seem similar. Both highlight zones where price reacts. But once you understand what's really going on under the hood, you'll realize they're two completely different beasts. Support and resistance zones are established when price rejects a certain level more than once. For instance, if the price rebounds from a level initially, and then does it again later, that repeated rejection becomes a valid reason to mark a support or resistance line. But order blocks aren't formed from price rejection, they originate from aggressive moves driven by large market participants. If you notice a strong, impulsive move in price breaking away from a level, that signals the area is likely an order block, as institutional money probably entered the market there. Support and resistance are most often drawn as horizontal lines. At times, traders might extend them into slim zones, but they still remain relatively narrow. Order blocks, in contrast, are illustrated as broader areas. They indicate clusters of institutional involvement, not merely a simple touchpoint. This larger zone reveals where significant orders were concentrated, rather than a place where price just reacted and moved away. Support and resistance levels can hold firm repeatedly. Price might react to a strong support level 5 separate times across several weeks. Order blocks don't behave like that, they act more as a one-time opportunity zone. When price returns to an order block and shows a reaction, that zone often loses its effectiveness. Why? Because the initial orders behind the move have probably already been executed. The smart money has played its role and exited the scene. Before integrating order blocks into your trading approach, you must first learn how to identify the correct ones. Let's go over the 3 core rules that qualify a valid order block. These aren't optional. They form the foundation of the entire method. Rule number 1. There has to be an imbalance, sometimes called a gap or inefficiency. Not every sharp price movement creates an order block. What distinguishes a valid one is imbalance, a price segment where the market lacked enough time or liquidity to establish balanced trading. This typically appears as a gap between candle wicks on the chart. Let's break this down. Imagine 2 upward price moves that appear nearly the same. Both show strong bullish momentum, but in one case, there's a clear gap, a space between the high of one candle and the lows of the next few. That gap signals inefficiency, meaning price moved so quickly that orders couldn't be fully matched. Only the move with this imbalance qualifies as a potential order block. To mark it, locate the final candle before the imbalance forms, then draw a rectangle from its wick high to wick low. That becomes your zone. Rule number 2. The order block must remain untouched. In simple terms, it has to be unmitigated. Order blocks aren't permanent, they typically offer a one-time trade setup. If price revisits the zone, even with just a wick making contact, that order block becomes invalid, as it's now considered mitigated. Why? Because the pending orders at that level have most likely been executed, the smart money has already made its move. So once you've marked an order block, monitor it closely. The instant price taps into it, treat it as used and move forward to the next opportunity. Rule number 3. There must be a break of structure or a change of character to validate the order block. This is the most critical element. Without it, you're simply making an assumption. A legitimate order block must cause a shift in market structure. If the trend is moving upward, price should break above a prior high. If the trend is heading downward, it should fall below a previous low. And if the trend reverses entirely, it must display a clear change of character. Here's an example. You might say the market made a sharp move downward, and there's a clear imbalance visible. So, this appears to be a potential order block. But for it to be considered valid, we need confirmation via a break of structure, specifically, a clean break beneath the previous support level. Now watch what unfolds. The market drops below that support, confirming the order block's validity. Then, as price pulls back into the order block, it gets rejected and continues its downward move. If the trend is heading downward, it should fall below a previous low. And if the trend reverses entirely, it must display a clear change of character. Now let's look at another scenario. This time the market pushes upward and breaks structure. As you can see, we get the first imbalance here, so we plot our initial order block. Then we spot another imbalance forming further up, prompting us to mark a second order block. What stands out is that this second order block lines up with a prior resistance level, adding confluence and boosting the chances of a strong market reaction. Watch what happens next. The market pulls back into that order block, gets rejected, and then pushes higher, confirming the order block's validity, now reinforced by the old resistance flipping to support. That wraps up today's video on ICT Concepts. Thank you for watching. If you found it valuable, make sure to like, subscribe, and hit the notification bell so you don't miss the next strategy breakdown. Thanks for tuning in, and I'll catch you in the next one.